Creating a powerful predictive algorithm usually involves a certain amount of hyperparameter optimization. This involves tuning a model's parameters to maximize a certain objective function, such as the Sharpe ratio in finance. One of the most popular methods is Bayesian optimization, which is a significant improvement in computational efficiency and results over both random search and grid search, two other popular ways of optimizing hyperparameters. When evaluating a costly black box function, Bayesian optimization is by far the most popular method for tuning hyperparameters. The process of developing trading algorithms differs little from model development in other fields. Data needs to be collected, cleaned, and structured. A model needs to be created and tested, and with that come the typical pitfalls of overfitting and data leakage. To measure whether a predictive model will work well, it is not enough to consider only performance over the training set, data that the model has previously seen and is referred to as in-sample. Models are expected to perform better in-sample than on previously unseen data, the out-of-sample set. This forms the basis of evaluating models, which can be quite extensive, and why it is so important to prevent data leakage, where information from the out-of-sample testing set can be inferred from the model during training. This would skew the model to perform better on the testing set than it would have if it had truly not seen that data before. A stochastic oscillator is a common financial indicator for trend strength and can be used in trading algorithms. It looks at the price of an asset at the close of a trading period and compares it with the range of prices in a number of past periods. We will use a stochastic oscillator momentum indicator as an example to illustrate the potential problems one can encounter when developing and tuning a trading algorithm on 30-minute Bitcoin prices from Coinbase. We fit the stochastic oscillator from January 1, 2019 through February 2019, and test over the next 2 months. A stochastic oscillator is defined as, where high and low values are calculated over the previous K trading periods, and T indicates time period. To generate trading signals, it is common to consider moving averages of %K. An exponential moving average, EMA, is a moving average that places greater importance on more recent data than a simple moving average. In the above equations, the subscript specifies the decay factor of the EMA in terms of a span, where we define an exponential moving average as the recursive function intuitively. %T is a measure of an asset as short-term momentum, whereas %Ts is measuring the long-term momentum. Therefore, if %T greater than %Ts, a buy signal is generated, and conversely if %T less than %Ts, a sell signal is generated. Based on this definition, the three tunable hyperparameters for a stochastic oscillator-based trading model are K, K, and K. The overfitting problem of a biased model in this scenario concerns tuning a model until the parameters specifically pick one or multiple highly successful trade S that maximize S, the objective function. This becomes significantly more likely with fewer constraints during optimization and higher cadence data, for example minute open high-low close candlesticks. Therefore, it is especially important not to be misled by the model's performance in the in-sample training set. Two constraints we chose to apply are limiting K greater than K greater than K, K greater than 20, and the latter constraint regularizes the K parameters to prevent overfitting in sample. After performing both regularized and unregularized Bayesian optimization over the same training set, the parameters optimized with regularization are K equals 1377, K equals 714, K equals 20 and K equals 1380, K equals 770, K equals 20 respectively. When looking at the in-sample trades of the two algorithms, one without K regularization and one with K regularization as specified above, it is clear that the in-sample performance is not much different, apart from slight differences in the timing of trades. Both algorithms generally buy and sell at the same time. However, you can read full post on CryptoFins News, link available in text below.